This week, Jamie Moles from ExtraHop is with us to discuss better threat detection by decrypting traffic for inspection. Then, in the enterprise security news, Devo, Dragos, Cato Networks, and Aura have all announced $200 million or larger funding rounds. TransUnion acquires Sontiq for $638 million. Summit Partners acquires Invicti for $625 million. Privacy engineering startup Piano, PPE, it's PII, it's a joke. PII plus Piano. Emerges from stealth mode. Will cybersecurity funding top $20 billion in 2021? New U.S. spyware export rules. A Silicon Valley entrepreneur wants to scan your eyes. All that, and don't forget to stick around for the squirrel story on this episode of Enterprise Security Weekly. And finally, we're a little out of order because we pre-recorded an interview this week. And it's one you don't want to miss, especially if you're interested in the market. I got to interview Mr. Will Lin from Forgepoint Capital, and he talks about his role in the cybersecurity market as an investor, as well as some industry trends. And it's a really good conversation.
This is Security Weekly, for security professionals, by security professionals. Broadcasting live from G-Unit Studios in Rhode Island, it's the show where we talk security vendors and aren't afraid to name names. It's Enterprise Security Weekly. When it comes to your network, visibility is imperative because you can't secure what you can't see. Riverbed's network performance management solution gives you 100% network visibility 100% of the time. Now you can resolve performance issues and security threats up to 90% faster and reduce response time, damage, and cost spent on remediation and containment efforts. Connect with Riverbed today and learn how their NPM solution can protect your network by visiting securityweekly.com/Riverbed. Whether your biggest cybersecurity concern is ransomware, unprotected network devices, zero trust success, or auditing your supply chains, firmware security is critical. Eclypsium's enterprise firmware security platform helps you identify devices and their firmware, verify the integrity of firmware wherever it's used, and fortify firmware throughout active remediation and automated patching. Visit securityweekly.com/Eclypsium to try out Eclypsium or learn more about enterprise firmware security.
Welcome to Enterprise Security Weekly, and happy National Chocolate Day. This is episode 248, recorded on Wednesday, October 28th, 2021. I'm your host, Adrian Sanabria, and joining me today is Tyler Shields. Hello, Tyler.
Hello, Adrian, as always, and happy Chocolate Day to you, too, although I don't like chocolate. I'm more of a sugar guy.
Oh, interesting. Yeah. I'm kind of the reverse. And I find it interesting that it's National Chocolate Day. Like, I would think there'd be an International Chocolate Day. Is there? And that's a different day?
Swiss chocolate, European chocolate, much better chocolates, maybe?
Yeah, of all the frivolous international and national days, I feel like chocolate's an important one.
I agree.
Also joining me for the first time today is Katie Teitler. Hello, Katie.
I knew there was a reason you asked me to be on today, because I'm with you, Adrian. I love chocolate. I agree with you, Tyler, though. U.S. chocolate isn't the best.
It's not very good at all, actually.
Yeah, so I've been to Switzerland and went to the grocery store, brought home a whole bunch of chocolate. Yeah, and they did not disappoint. They had an entire aisle just dedicated to different kinds of chocolate. It was wonderful.
Additional information from our wonderful researcher, Sam. In the background, she has let us know that World Chocolate Day is officially Thursday, July 7th, 2022. So if we want to talk about that in July, we should put that on the to-do list.
I'll make note of that. All right. InfoSec World 2021 is proud to announce its keynote lineup for this year's event. Hear from Robert Urjevec, plus heads of security at the NFL, TikTok, U.S. Department of Homeland Security, Stanford University, and more. Plus, Security Weekly listeners save 20% on digital pass registration. Visit securityweekly.com/ISW 2021 to register now. All right, and today's topic is a very interesting one. We're excited to have Jamie Moles with us. Am I saying that right, Jamie?
It's not Jamie Moles is correct. Yep.
Okay. The Spanish
like
in me wants to say
things that dig holes in your garden.
Yeah. The Puerto Rican in me wants to say moles, but
that's, I get that.
That's a more culinary version. Jamie is a senior technical marketing manager from ExtraHop and has a wealth of experience in a lot of things. As we've discovered chatting with him on the phone, he is a Rubik's Cube fanatic, has those crazy 7 and 8 dimension Rubik's cubes you've maybe seen in catalogs and things like that, and has been in the computer industry for over 34 years. Not going to go into all the details. I think you've covered a lot of ground there, have a lot of really interesting knowledge. And I think it's a really interesting topic we have today, talking about, the ability to catch more threats basically by decrypting data, and there's a lot to talk about there. But first off, all the time you spent in the industry, maybe tell us what are some highlights, or how did you get into security? Because it sounds like you were in IT before you moved over.
Yeah, so I joined the computer industry straight from school. And over here in England, unless you go into university, you tend to leave school at 16. So I left at 16, bright-eyed, bushy-tailed, not knowing anything. And I went to work for a company, a local consultancy doing desktop publishing, which is something most people on this call will probably never have heard of because they've always used Microsoft Word. The company was headed by a man who was an ex-sound engineer who used to work in studios recording for people like Hart. He used to be a radar engineer in the RAF, and he was a complete techie. And it was a brilliant introduction to the computer world for me, because he taught me how to build computers. He taught me how to program in C and assembly, taught me how to, we started out with Novell networks and things like that. And from him, I learned very early on that I don't like boring things like project management software and spreadsheets. I like interesting things like compilers and security tools and unerasing hard disks and other whizzy stuff like networking and virtualization and stuff like that. I got into the industry via that opportunity. Back then, we called it the computer industry. Now it's IT. No one had ever heard of the phrase IT. And I've always had primary interest in utilities or computer systems, networking, anything that's used to build, if you like, the applications and services that other people use.
I'm a huge spreadsheet geek, so I don't find spreadsheets boring at all. I like to use them to solve problems, but I think that's a very particular person, a person that loves spreadsheets. I've got one where I just analyze F1 performance and compare last year to this year and some other stats and stuff like that I can't find on websites.
You're a Formula One fan. We should have a conversation offline because I could talk about that for a very long time.
Oh boy. Yeah. Oh boy. Don't get Adrian talking about Formula One. Don't get him talking about spreadsheets, and definitely don't get him talking about spreadsheets about Formula One.
Okay, so I shouldn't talk about all the work I've done with the Formula One teams, and I shouldn't ever show him my photograph of me arms in arms with Rubens Barrichello and my brother and my dad when I was a guest of Williams at their testing several years ago.
Oh my goodness, the jealousy.
Yeah, that's a hard no. That's a hard no. You definitely shouldn't do any of those things. Hard no.
Shouldn't even talk about them.
Ignoring that potential rabbit hole and moving on. So you've got this, ExtraHop is working on this idea, this concept of using decryption, which is not novel. It's in itself, it's not new to detect threats. We know some attackers will use encryption to evade detection, and in some cases it's our own encryption that makes it a little bit harder to figure out what's going on our network. and of course we've got to do it, for security, for privacy and things like that. But then on the investigative side, sometimes it benefits us from being able to break it open, take a peek inside. So I think one of the places that we should start here, Jamie, is when I talk about decrypting traffic, for a security use case, for analysis, there's kind of a typical case or use case or architecture that's going to pop into people's minds, and you're doing things a bit different. So I think we should kind of start there and set the context for this.
Yeah, that's cool with me. So let's talk about the kind of decryption that most people think about when you talk about decrypting traffic, which is man-in-the-middle decryption. It's where you have something like a proxy, which you're routing your traffic through, your web traffic typically, and your administrators of your networks have configured that so that perhaps it's the only egress out of your network. So the only way you're going to get to the internet is by a browser that's configured to speak to that proxy. And that proxy has the ability, because it's sitting in the middle of your communications stream, it has the ability to interrupt your communications with the outside world, sit in the middle, and decrypt what you're sending out, which is a really useful tool because obviously it's going to go both ways. You can decrypt inside and outside. And tools like that have been very, very useful over the years for protecting your networks from threats inbound, but also enabling you to control what's going out of your networks. The problem with it is, and has been for some time, that it really does make privacy advocates tear their hairs out. Because if I'm intercepting all of the traffic that's going through the system and I can see even the traffic that's being encrypted, there's a risk that I'm going to see things that I shouldn't do. Now, admittedly, most enterprise organizations using systems like this will set their systems up to not do that. The obvious case that people are worried about is if my company's decrypting my internet traffic and I access my online banking, can they access my online banking and intercept it or see things they shouldn't do? Which is a very straightforward privacy breach if they do that. And of course, most enterprises, if they're good and reasonable, will configure whitelists on their systems to not decrypt that kind of traffic. But you can't know everything. And you can't know everything that users are going to put through. And there is always a risk with man-in-the-middle decryption that you're going to decrypt something that could put you at risk of breaching some of the data security standards like GDPR, PCI DSS, etc., that you shouldn't be. And that is what most people are aware of or think about first when you talk about decryption of traffic. Decrypting things that are going through the perimeter, going out to the internet, and decrypting typical web and FTP and sometimes email type traffic. What we're doing, so did you?
Yeah. Well, you were probably going to go right there, but I was going to say, that was kind of the next bit of context that I think is important here. Is again, people are going to automatically think, okay, you're breaking TLS. You're inspecting north-south TLS stuff going, off to the internet somewhere.
Exactly, and of course, the TLS standard itself doesn't let you do that anymore. So if you're implementing TLS 1.3 in your environment, that standard was specifically designed to prevent man-in-the-middle of traffic. So that's kind of an issue for anybody who's using that kind of interception anyway. At ExtraHop, we have a different view on how you should look at traffic. So the first thing is, when we deploy a decryption capability to our customers, we are passive and out of band. So we're not in the flow of traffic. This has a number of advantages. The first thing is obviously not being in the flow means that you aren't introducing any latency or slowing down traffic or anything like that. But by being out of band and passively analyzing packets that go through the system, you're actually capturing packets in an encrypted form. Now, how you can then decrypt that very much depends on the type of encryption used on the traffic going through. If you're using older RSA algorithms, for example, and if you, as a ExtraHop user, are in control of your encryption, and this is really important here, we are only decrypting things for which you have the keys. And that's really important when you consider privacy implications. So if you are in control of your own PKI infrastructure, let's say you're running a Microsoft network, you have Exchange, you have SQL, you have domain controllers and things like that, and you've deployed it in a secure manner, you have control of the digital certificates that will allow for the decryption of that traffic. You can forward a copy of it onto our appliances, and they will decrypt that traffic for you, unless it's TLS 1.3. Because with TLS 1.3, obviously, for those who aren't completely aware on this this podcast, with TLS 1.3, the encryption keys are what we call ephemeral. They are negotiated at the time a conversation starts, and they change. Every time a new conversation starts, it's a new key. So having a digital certificate with private keys in it doesn't help you because they aren't relevant to the conversation. So you have to have a mechanism to capture those keys. And so long as it's on your own infrastructure, we provide that. So we have what we call a PFS forwarder. You can put that on certain parts of your infrastructure, such as Windows and Linux servers, and that will capture those ephemeral keys and share them with us in a secure manner that allows for us to take the encrypted traffic streams, decrypt them, and show you what's going on inside those communications.
Yeah, I think another important point here is that you're not wholesale decrypting everything. It sounds like you do let the customer kind of pick and choose what they want to decrypt, because even if you're not in line, it's still a very touchy subject when you're decrypting stuff. Certain data streams, certain communications between applications, you get in trouble with regulations and things like that if you start peering into that data.
Yeah, absolutely. So I call this strategic decryption. And what we mean by that is you are only decrypting that for which you have the keys already. So you're only decrypting things that you're encrypting, which means quite literally that if I do have a user in my network who's accessing their online banking, I can't possibly decrypt that. I'm not in line, I'm not man in the middle, and I don't have the keys from the banking application to be able to see that traffic. So by using this method of decrypting traffic, you're preserving privacy whilst still enabling your organization to look at the traffic it generates in order to look for risk and look for threats within that traffic. And decrypting traffic that you have control over inside your own private networks, not public networks, not open networks, is a perfectly legitimate thing to do. There are a number of privacy standards and data security standards like PCI, like HIPAA, like GDPR, that mandate that if you are sending traffic over open public networks, you must encrypt it. And you need to use secure standards and strong encryption and strong security protocols to protect that data. It might contain PII, it might contain PAN numbers and things like that. However, none of these data security standards mandate that you have to do that over your own internal private networks. Now, we're doing that. Most organizations are encrypting traffic over their own private networks because it's simpler to do it. If you're starting at the endpoints or the servers and you're sending things out via the internet, that's where you're going to be encrypting everything from anyway. So you have that level of coverage. But there's nothing in any of these standards that says you cannot re-decrypt traffic that you are encrypting with keys that you have generated and that you own yourself. What does this mean practically? Well, it means that as long as you're out of band and you're not interfering with the traffic anyway, you're looking at a copy of the traffic, you can decrypt that copy without touching the original traffic going through your systems, without interfering with the user's privacy or their their operations in any way, shape, or form. And if you decrypt that traffic for which you have the keys, and there are numerous types of traffic you can look at. There's obviously TLS type traffic, and now TLS for PFS or TLS 1.3, but you can also look at, nowadays, we can look at some of the Microsoft protocols that are on the inside, the east-west corridor of your system, like Kerberos, NTLM, MSRPC, WinRM, LDAP, and SMB, which the latest standard of SMB is version 3 as well. And if you can safely and within a reasonable scope and within agreed plans with your own GRC teams and things like that, decrypt that traffic for the express purpose of looking for threats that are targeting your business, and with the agreement that, you can, if you don't find threats, you can throw away the packets afterwards or whatever, then it should be an entirely reasonable position to take that this traffic could hide risk. And I want to reveal that risk and deal with it if it comes up.
So it's interesting because you were talking about the encryption, decryption in terms of key management, but we know that so many organizations are just bad at key management. It's kind of a crypto mess out there. So how are you dealing with companies who don't know where their keys are, aren't rotating their keys, are just basically messing the whole thing up? Because it sounds like it should be an easy thing to do, but there are whole companies dedicated to managing other companies' keys for them for this very reason.
That's a really good question. And honestly, I've got to say the situation today is so much better than it was 20 years ago. When you look at like 20 years ago when PGP first came out and things like that and started being used in the world, encryption 20 years ago was hard. It was very, very difficult to implement. It was, when you had implemented it, you then had worries about the security and the safety of the keys. Key distribution and sharing was problematic. And of course, the worst part of encryption back in the old days was implementing it correctly and well. Implementation has always been the weak part of encryption systems. If you can have the best encryption software in the world, but if you deploy it badly, you're going to leave yourself open to holes and to risk. And that's what catches most people out in the past. Nowadays, it's a lot more simple because encryption is ubiquitous. It's everywhere. It's built into everything because it's such a panacea to risk. It solves so many risk problems. Risk guys come in and say, oh, you can't do this with the data that's moving around the networks. The data's encrypted. Oh, okay, you're fine. Key management is still an issue. And, there are hardware systems out there for managing keys in a lot of situations. The way that we are managing that side of things is, firstly, you need to look at the scope of where you're going to deploy decryption. And you should be deploying decryption in a sensible, controlled manner, only where you need it. With ExtraHop, we have an agent, which we call a PFS forwarder. And that agent is deployed on critical assets in your environment. So you might deploy it on your domain controller, you might deploy it on your Exchange cluster, you might deploy it on your SQL servers and Linux servers as well. And that will get you TLS 1.3 and other TLS standard traffics. And for other earlier ciphers where the private key and public key are held in digital certificates, and that digital certificate tends to delegate down to other certificates and authorities, you can simply provide that certificate to our appliance, or it's stored securely, I have to say, in memory that cannot be read back from. So I can write a certificate to it, I can delete the certificate, I can overwrite the certificate, but I can't get it back out, which is part of the way that we keep your encryption secure, which makes it a lot easier. So we're not talking about mass deployment of decryption. You don't want to decrypt everything. It's hugely impractical to do that in reality. So you're going to encrypt in certain parts of your network within a reasonable scope of devices that are critical and which you care about. And you're going to get the keys from digital certs or from a very small agent which we can deploy on your core infrastructure servers.
So I have a question, a follow-on question for you. So even if we can properly manage encryption keys and we can decrypt in appropriate locations and all of those things that you just mentioned, your system then actually goes in and understands the protocols enough to look for anomalies, correct?
Correct.
So what happens if I were to create a rootkit or an exfiltration technique that uses like DNS entries to blast data out? Are you able to detect kind of those network layer, very unique protocols that might be doing data exfiltrations in an anomalous way?
Yeah, absolutely. So at ExtraHop, we use what we call full spectrum detection. And I'll explain what I mean by that. Full spectrum detection allows us to use a number of different detection technologies. And I'll be completely open with, we're not precious about what technology we use. It's very often the case that security vendors say, oh, we're doing lots of machine learning, or we're doing this, that, and the other. At ExtraHop, we used detection technologies that are appropriate to the use case. So we're using machine learning, and we have a number of different methods and models that we use in machine learning. But we're also using signatures, because sometimes signatures are just more appropriate. As an example, if I saw someone attacking my web server with the Drupal-Geddon exploit, I can pick that up instantly with a signature. Why would I use something like behavioral analytics or machine learning, which would take longer? It's not appropriate. We use behavioral analytics as well. That has a very useful place in examining network traffic. And to get back to your point about looking at interesting traffic that's new and not been seen before, that's where signatures are going to fall down, obviously. Signatures work where you have something that someone's already detected before and created an IOC or a byte string that you can look for, and that will detect very, very quickly. Machine learning, for which we have a number of models, as I've suggested, is a really nice capability. But the thing to remember about machine learning is basically what it's doing is it's looking at new inbound data and comparing it with data it's already seen before in the past. And the purpose of machine learning is to say, have I seen this before? Is it good? Is it bad? Is it ugly? And the idea is to find anomalies in traffic. Now, if I'm looking at all of the traffic in your enterprise that you're decrypting and that you're providing me a copy with via a span or a tap, we at ExtraHop, we look at over 70 protocols in the East-West channel. So we're not limited in some of the older IDS terms by looking at only perimeter traffic, where you might only look at 10 to 20 protocols. We look at all of those protocols. We look from layer 2 all the way up to layer 7. So because we're doing decryption, we can look at layer 7 payloads, which is fantastic. And we can look at protocols like DNS. It's very common today to see tunneling over DNS and plain tunneling over UDP, not necessarily over DNS itself, and TCP. And the interesting thing about some of the detection capabilities that we have is that our analysts have spent a lot of time looking at vast amounts of traffic and looking for things that are normal to an enterprise. And we put a little bit of security domain expertise into that as well. So we have unsupervised and supervised models. And we've done some diving into deep learning as well. Obviously, the supervised models know a bit about security domain stuff. The unsupervised models look at traffic and tell you interesting things about it. So if we have a new type of exfiltration using TCP or UDP, using ports that are not normal, what we're going to see is this workstation, who doesn't normally do this, has all of a sudden started communicating with a machine in the outside world over a protocol that we don't know about. And it's going to send a certain amount of bytes out, and it might do that on a repetitive basis, and there might be some on the way back in. But generally, the pattern of the traffic flow is going to look unusual. It's going to look out of character for that machine. Now, we use two primary models in this space for looking at things like this. So we use what we call predictive analysis, and we use peer group analysis. with predictive analysis, which is frankly a machine learning model that most security companies will be using. It works on the basis of, if I know what you did yesterday and the day before and the day before that, I should, with a reasonable degree of certainty, be able to predict what you're going to do tomorrow. And obviously, the more time I've had watching you, the more likelihood that my predictions are going to be accurate. So when you do something out of character, that's an anomaly. And that's interesting. And that's going to get our detection systems fired up to take a look at that traffic and say, that DNS traffic is something we've never seen before. This looks interesting. Let's look at the packets. Let's see if there's anything in the DNS traffic that we can pull out that looks like a payload, or perhaps we can take the destination address and compare it with threat intel and draw on other sources of information to come and say that there's an interesting thing happening here. Let's bring it to the attention of a human being. But it's not just predictive analysis we use. Like I said, we use peer group analysis. And with peer group analysis, what you're doing is you're taking arbitrary groups of machines that act in a similar manner to each other. And you don't care about the job function of the person running the machine. You don't care about the geography or what floor in the building the machine is on. All you care about is they act very, very similar to each other. So you might say that a whole bunch of people in finance do very similar things day in, day out. They access their email, they access spreadsheets, they access various file shares. If a machine within that arbitrary group sticks its head above the parapet and starts behaving in a manner that's different to the rest of that arbitrary peer group, that's an anomaly. And that gives us another reason to look at that machine. Now, with those models, they're not separate. We combine our models. We make them work together where possible. So if I have an anomaly alert from a predictive analysis machine for workstation A, and I have a peer group analysis alert from the very same workstation, that actually increases the probability that I'm seeing a real anomaly that's worth investigating. So we can do that across many, many different types of traffic. We can be traffic agnostic in reality and analyze pretty much any TCP or UDP protocol, whether it be a well-known one or a bespoke one, to come up with conclusions about what might be malicious C2 traffic.
And so as we wrap up this conversation, it sounds like it's fairly straightforward to deploy this into an environment. It sounds like you've got the piece that captures the traffic and does the analysis, and then you've got the piece that gathers those keys and sends it over there so that it can do the decryption and perform that analysis. Is that about right for the architecture?
Absolutely. And let's be clear, actually. We've talked about using decryption for detections, but I also want to briefly talk about the other value point here, which is it's all well and good having decryption coming in place and looking at all of these protocols. And like I said, it's very straightforward and easy to deploy, and looking at and giving you detections. But for me, one of the stronger value points about decryption comes down from the incident investigation side. And what I mean by this particularly is, if I have a whole bunch of detections in my system that show a chain of attack, and I see things like lateral movement, for example, or my web server for some reason accessing my database server, if I can decrypt that traffic, as an instant responder, I'm in a much better position to firstly determine the nature of the threat. Is it actually a threat? If my web server is an e-commerce server, it's going to be accessing my database a lot. That's normal. But if I can see the SQL statements it's executing against that server, and I can see things like drop tables against my product list, I know someone's trying to take my server offline. That's not good. And being able to see that information enables me to make better decisions and respond better as an instant responder. And possibly the most important thing, I think, for the instant responder comes down to credibility. I think any of us who've been in the industry a long time and have done any sort of incident investigation and response We always hate having to go back to the business with an incomplete picture, because we know what we know, and we worry about going back and telling the business, well, this is what we saw, this is what we think happened, this is what our logs tell us, but of course, logs don't cover everything. This is what the endpoint agent has tell us, but of course, the endpoint agent's only on the endpoints we can install it on. And therefore, we've interpreted this to tell us that the bad guy got in here, moved around these systems, touched these systems, and we've cleaned them up. And someone says, well, what about the systems that don't have an agent on? Or what about the systems that you don't have logging for? How do you know they haven't touched them? And the answer is, I don't know. Whereas if you're looking at the network and you're decrypting the traffic and you're looking at the payloads and you can see the actual actions that bad guy is taking, you should be able to go back to the business with 99% certainty of everything you have seen and be able to say to them, we saw how the bad guy got in. We saw the exploit he used to break into our e-commerce server. We saw then the reconnaissance he performed from that e-commerce server that allowed him to understand the layout of our network, routes through our network, and the other devices he can get to. We saw him perform steps through the network from a few different workstations till he got to a administrator's workstation, which he compromised. And from there, we saw him performing, DC sync attacks against our domain controller and using his access to those systems to get a Kerberos golden ticket on our networks, which then allowed him access to everything. And from there, he could exfiltrate data from our file shares. He could access our Exchange server and read emails. We saw all of this. We saw everything he touched, and we know what we have to do to clean it up and stop him getting in again. At that point, the business should be happy, and they shouldn't be asking difficult questions because you come to them with full confidence that you know what's happening. And that's what looking at the network and all of the communications and conversations between all of your workstations, servers, and services, and decrypting that where you have the keys and the authority to do so, that's the power it gives you. Great to have detections. Great to have a system automatically catching the bad guys for you. And you only need to catch them once, doing one bad thing before you can see what they're doing. But to also have the visibility of what they've actually done, that's a superpower. And that's something I want every customer to have, because that's how they'll keep the bad guys out.
Absolutely, 100%. I totally agree with the, it's an excellent point on having that confidence and being able to fill in those gaps so you can tell the whole story, so that when somebody asks you, how do you know that for sure? You can kind of lay it all out for them. Jamie, thank you for joining us on Enterprise Security Weekly today. It's a super interesting product, and I think that was a pretty comprehensive overview on what it can do.
Thanks for the time. It was really great to spend some time with you.
Yeah. So this segment was sponsored by ExtraHop. If you didn't get that from the conversation, go to securityweekly.com/ExtraHop to find out more. And stay tuned. We'll be right back in a few moments with the weekly enterprise news.
Cybersecurity is about more than just technology. It's about how people behave with emails, data, and cloud applications that directly impacts your company's security posture. Security works best when it's ingrained in the culture of your organization. To learn how to build a security culture and transform your employees from targets into a strong line of defense, head to securityweekly.com/proofpoint and visit their Cybersecurity Awareness Center. The hybrid workforce is here to stay, and it requires real-time visibility, control, and rapid response of every endpoint, whether it's in the office or home. Tanium offers an endpoint management and security platform built for the most demanding IT environments. Many of the world's largest and most sophisticated organizations, including nearly half of the Fortune 100, rely on Tanium to deliver unmatched endpoint visibility and control. Whether you're preparing for zero trust or protecting your network from supply chain risk, Tanium empowers technology leaders to achieve greater agility, efficiency, and confidence. Learn more at securityweekly.com/Tanium.
Welcome back to Enterprise Security Weekly. Security Weekly Unlocked will be held in person this December 5th through 7th at the Hilton Lake Buena Vista. Keynotes from Alyssa Miller, John Strand, Leslie Carhart, and Dave Kennedy. Visit securityweekly.com/unlock to register and check out our rockstar lineup. And now, on to the Enterprise Security Weekly news. I've got quite a few stories in here. Katie, I was talking about how I'd categorize it and throw in the text and stuff like that. You get the... you probably see what I was talking about now.
Yep. Absolutely.
Yeah, I just need to turn this into a blog post because I end up writing so much stuff in there, it might as well be. But if you want to read these along with us.
Blog posts short, though.
What's that?
They do say to keep blog posts short.
Yeah, that would be a challenge here, clearly, for me. Maybe some of these stories alone are probably a blog post. That's a good point. Yes. What we're talking about, if you go to securityweekly.com/ESW248, you can see the show notes that we're talking about, and you can see all our notes there.
You can read Adrian's dissertations, and you can see his amazing hair in his photo.
So, funding, we always start out with funding, and it's just, it's even crazier than normal today. It's an easy, $1.5 billion in funding?
Yeah. I was trying to do the math real quick, and there were too many zeros, and I got lost, of course, because I'm not very good at math. But I mean, it's a lot of money. Holy smokes.
Yeah. Yeah. So 3 companies at 200 million, right at 200 million. Dragos raised 200 million. Cato Networks raised 200 million. A computer security firm I had never heard of called Aura that does like identity protection, kind of like LifeLock, like Norton LifeLock has. They raised 200 million with a 2.5 billion valuation. And then Devo, who we know well, we just did Analyst Day last week, was part of Enterprise Security Weekly. Last week is over there, apparently. It's over my shoulder.
Yeah, I mean, these numbers are astronomical. I mean, when you start to do a total of $1 billion, not a valuation. This is $1 billion of funding. Think of how many businesses you could really build with $1 billion in your hand. And we're talking about loading this into 5 companies and letting them rip. That's just absolutely insane size of businesses right now.
And even 10 years ago, these numbers would have been absolutely unheard of. But so much money is getting poured into the industry. It's both good and bad, right? We know the good, but the bad is that you're going to have a lot of companies that are started by people who think this is a get-rich-quick scheme, and it's not in any way, shape, or form.
I'm pretty sure SpaceX was putting rockets into space with less money than we're seeing in the show notes today.
In the show notes today, I love it.
I think they were putting in, they had about over $1 billion, like $1.5 billion in funding when they started actually sending up.
Though? Didn't it crash?
Shh, it was all fine. It was fine. It's okay. Yes, there were many crashes. That's why they needed $1.5 billion.
They needed more money than we're talking about today for things that can crash and burn in a metaphorical sense.
Yeah, and Aura is like a VPN app for your phone and identity protection. And I mean, some of these are pretty big deals, like Devo, place to put it's basically a Splunk competitor, place to put all your data and to do all the analytics. That's pretty expensive to scale out. You're putting potentially petabytes a day into there from customers. So, that's none of these are easy companies to build or easy products to scale up. Especially Dragos is talking about, scaling to the Middle East and basically all over the globe. But it's still a lot of money. It's still mind bending.
Yeah, I mean, to be totally fair, these companies, like let's take Devo, it's an amazing company. They're doing badass things. Their growth rate is astronomical. Their ARR is insane. But I like in your notes, right, where you say in the show notes you put, sorry Devo, nothing personal, but I propose we move the number so that we continue using the term unicorn to refer to startup valuations that are extremely high, that are so high that they're rare. And that made me chuckle because unicorns are no longer rare. Unicorns are the zebras of the zoo, right? Everybody's got a zebra in their zoo. So yeah. It's time to maybe we start calling them rainbow unicorns or something, that's even more rare. But like I said, these ones are pretty amazing. Devo is doing some really, really great reinvention of data analytics and really trying to look to disrupt Splunk and others in a way that hasn't been done before. So, Devo is amazing. You got Dragos on the OT side, and that it's growing drastically on these critical infrastructure protection plays, and Cato Networks as well. Trying to take out Zscaler, or at least target Zscaler in what they do. So, we're not talking about little companies that are doing, a new, unique, novel little niche play. These are massive companies that have very large growth rates. So, in their defense, maybe they deserve the funding that they get.
Oh, for sure. I've spoken to three of them in the past and been very impressed. And they, like you said, they're not doing anything new, but they're doing it in a way that needs to be done today, right? Because there hasn't been a lot of innovation in the SIEM log management world. And Devo is certainly doing that. In terms of SASE and where that's going, Cato's taking a completely different approach than a lot of their competitors. And there's a lot of work behind the scenes that goes on that I don't think a lot of people realize when they want to start up a company. So my comment wasn't to say, oh, you can get rich quick, because certainly none of these companies have been an overnight success. There's a lot of hard work, and I think they're all really impressive, and I'm sure they are deserving of money, but it is also astonishing how much money is in cybersecurity, especially given what's going on elsewhere in the market.
Yeah, the last thing I'll say about Devo before I kick it back to Adrian is, they named themselves after an awesome band.
Yeah, I'm sure they get that a lot.
We'll put some pictures in the Discord. We'll throw some images up there.
Yeah. So Katie, to your point, story number 13, is trying to guess where we're going for the year, what we're going to hit when the year is over. And right now it's tracking to maybe hit $20 billion in funding for cybersecurity this year, which is huge growth over, I think, any other year we've seen, any way that you cut it. Number of funding deals, number of M&A events, amount of funding. Like it's just, if anything, the pandemic made some of this go faster. Like at the beginning of the pandemic, we were like, what's going to happen with the VC funds? Are we going to see stuff slow down, or people used to meet in person, to figure out some of these deals, to go to IPO and stuff like that. Doesn't look like it's had any impact at all.
Well, I think just like some other markets, because of the pandemic, people couldn't really go out. They were working at home. So they were saving on things like vacations and clothing and any money, you'd go buy lunch when you were at the office and now everybody's eating at home. All of that money was reallocated to things, namely home improvements or building out your home office. I think some of that happened in the tech space too, right? Because there was a huge need for it, obviously, when everybody rushed home and some people didn't even have computers, much less a space to work. And even though remote work had been catching on before the pandemic for years and years, industry estimates were something like 25 to 30% of workforces were remote at any given time. Now we had a lot of companies running at 90 to close to 100% for certain periods. Now it's getting to be more of a hybrid work environment, but that necessitates even more changes in terms of access controls, in terms of identity verification. And so it makes sense that cyber has just hockey sticked up. But wow, those estimates that you sent over.
Yeah, I think
the money that, like Tyler said, I almost can't conceptualize what that means. It's so much.
I know, and I love the idea of like some VC. what you're kind of comparing consumer spending, with things in the investor world, and it just tickled me, like the idea of some VC firms eating out fund is now somebody's Series A. Because it wouldn't surprise me. It could be.
And some executives are going to make enough money to eat out every night for the rest of their lives if they're working really hard and have a great product.
So one thing about this trend, this the numbers that we're talking about and the growth of the market in general, I think, and it's funny, I've been trying to justify this to myself now for 6 months. Like, how can there be so many cyber unicorns? And I think fundamentally we might be at a shift in how infrastructure is done, how companies are built, how products are built, that is so drastic that it is literally upending cybersecurity across the board. And I recently tweeted about this. And where I'm going with this is like cloud, API, SaaS, all of those changes, those innovations have occurred within the last X number of years, 3 years, 4 years, 5 years, and have yet to be truly digested by the cybersecurity market. And I think what you're seeing is a reinvention of cybersecurity in that kind of transformed landscape of modern business. And that's why we're seeing so much growth. I mean, maybe I'm crazy, Adrian, but that's the way I see it.
Yeah, no, I mean, we can definitely see that in some of the specific trends. And I just wanted to point out, these are some of the key topics I bring up in my conversation with Will Lin. So make sure you guys check that out also when you get a chance. We're going to air it live after we're done with the news segment here. But that's one of the first things I ask him is, all this money, where's it coming from? Why is it happening? And, he gives like a financial answer, and then he gives more of like a market trends answer as well. Because of course the financial answer is pretty simple. Interest rates are low. A lot of companies are flush with capital, and they need it to return something better than inflation. So they need to put that money to work. So
yeah,
and
money's cheap. Money's cheap.
And we're a better bet than a lot of other industries. I think that's part of it also is, we might not have like the crazy 200,000x returns, that like a Snapchat or, some of these tech firms have, but we also don't have the 70% failure rate that some of these other tech markets have. So more often when we fail, it's only 10x or only 5x, right? But you're still making money.
Well, you better be careful, because if you keep talking about this topic, we will eat up the entire news segment, because I could talk about it for days.
Yeah. So, I didn't have anything specific to talk about, some of these big ones. And really, we're covering, like, this is story 1 through 4 plus 13.
It's literally so much of the news.
Yeah. We've covered a lot of ground here. We also have 2 acquisitions that are about the same size. Invicti Security. Most people don't know the parent company name, but they make the NetSparker and Akinetics AppSec scanning tools, and they got acquired by Summit Partners, which I assume is a PE shop.
It is.
And then TransUnion acquired Sontiq for roughly the same amount. Just both are $6.25 million acquisitions, and Sontiq was bought from a PE firm. One of these cases where they acquired a bunch of companies and kind of glued them together, all around the same category, which is identity protection, and restoring people's identity, protecting it, rebuilding their, when their information gets breached, basically. So another LifeLock, a LifeLock competitor, basically. Which makes sense going to TransUnion, and add a little note about, the irony there, of course, is when Equifax got breached, they tried to sell everybody their solution to them losing their data, which the irony was not lost on many of us.
No, there were many comments in the Twitter sphere and in the social sphere when that occurred.
Yeah. So some new companies I'm not terribly familiar with. One of them, Triple Blind, is interesting. Is this the privacy engineering one? No, is that piano? No, Triple Blind. So Triple Blind is it's more around data sharing. So I think one of the toughest problems in cybersecurity is securing data. You need to be able to share it with partners. You need people to be able to look at it, perform analytics on it. Data scientists need a lot of data, but obviously it's a big risk. If that's production data and it's, some developer has the entire production database or customer database on their laptop or something like that. So I think that's kind of what they're trying to solve here. It's very difficult to kind of crack through the language on the website. They're saying stuff like real-time data de-identification without the cost or loss of accuracy with practically zero probability of re-identification.
So is this synthetic data? Is that basically what we're talking about here?
No, so that is on the privacy engineering side, and we have actually seen, we saw a series of privacy engineering startups over the last couple of weeks. We've seen 3 raise a Series B, and then we have Piano. So story number 9 is privacy engineering, and that's all around, let's get a safe copy of data to people to be able to do stuff with. But yeah, it tends to be synthetic data, or they scrub production data so that there's no PII in it and replace it with fake stuff, or some of them generate fake data from scratch. But in this case, this is like, I'm contracting some data scientists to pull some insights out of this data. And it's for cases where, they're talking about healthcare, about GDPR, cases where you've got HIPAA regulations and stuff like that, and you're leaving money on the table because you can do more with that data. So I don't know if they're talking about selling this data, but basically some version of, I need somebody to be able to pull some insights out of this data, maybe a data scientist, something like that. But I don't want to take the risk that, they could see PII and leak that somehow.
Some sort of data obfuscation plus data analytics in a crystal ball.
Right. And I think the idea is like to pull some of these insights, you don't need people's individual addresses. You don't need to know who had what treatment. You don't need those kinds of details. But in pulling those insights out, typically somebody's going to give you access to the entire data set, and you're going to have access to stuff that you don't really need to do the job.
Right.
So solving that problem.
Yeah, I'm gonna throw my
good idea.
I'm gonna throw my 2 cents in on this one and say that the marketing speak that I read is a little buzzwordy, and I would love to get a briefing from them so that I can truly understand in depth technically what they do, because based off of I read proprietary and crypto in the same sentence, which is an instant red flag for me. So if you guys are listening, I'd love to get a briefing, and so we can dig into the technical meat of what you do, and then I'll say 2 thumbs up if it makes sense.
Yeah, but one of the biggest problems we have in the cybersecurity vendor space is marketing buzz, and saying that as a product marketer. So agree with you 100%.
In this case, it's hard to tell if it's intentional or not. If it is, it works. It's a hell of a teaser, and they do have the click here to schedule a technical debrief with us button on the website. So if it's intentional to frustrate you and make you want to talk to them, it worked. It worked.
It worked on Adrian. He's in. Give him a briefing.
Yeah. Same with you, Tyler. Let me know if you get a briefing. I'll jump on there with you. All right. There was another new startup. Yeah, I mentioned it, Piano. So Piano's on the privacy engineering side, which we kind of described. Not super exciting, but very necessary. Again, trying to, developer they don't care if all the data in the database they're working with is fake in a lot of cases. They just need something to work off of when they're developing. So privacy engineering, at least this end of it, the dev focused end of it, is all about letting them do that job without the risks of having actual production bases flying around or, crossing their personal or work laptops.
Yeah,
is the way that I read this.
Yeah, this one at least seems like it's grounded in some, meat of technology of providing scrubbed fake data that actually maps to the correct, structure, things like that. That sounds like it's a reasonable approach.
Yeah. Worth noting that this is a Weil Ventures seeded company here. They led the seed round, which is a healthy $9 million.
No, $9 million. That's a drop in the bucket in today's rounds.
It used to be Series A. Now it's seed.
That's my angel. That's what I invest as an angel.
I think I'm going to skip number 10 here. That's been talked. They covered that on ASW. They covered it on PSW. I still think it's, if you haven't read up on this NPM package that got somebody basically threw some malware into an NPM, a very popular NPM package. We've been talking about these kinds of supply chain threats forever. You've got a single person that's responsible for an open source library that everybody uses. And it's really easy to target that single person, and they click on a link in a phishing email and, somebody steals their creds and now they've thrown, and I say malware, it's one of these cases where it's like, you think about what the bad guys could have done and all they came up with was mine Monero. So they throw Monero miners on your machine when you update this NPM package.
Well, so this just tells you how stupid the hackers are, because if they were smart, they would have mined Shiba Inu, which is up 700% in the last 2 weeks. So they're just stupid for mining that particular one.
I saw that.
Yeah, Shiba Inu, go figure. I had a buddy of mine tell me about a month ago to get in, and I thought he was insane. And here he is, 777% up. But neither here nor there. Those supply chain attacks, the reason why those things are so scary, quite frankly, is the force multiplier of the supply chain. I pop one NPM package, and I get it in everywhere, right? Especially if I pop a package that's widely distributed. So that's always, to me, the supply chain style attacks. It's like poisoning the water in a city, right? You just hit so many targets with it.
So for the first time, I've got a couple crimes in here in the stories. We've got one, I don't want to call it a company because it was pretending to be a company. Pretending to be an email security company, managed to raise $50 million from investors, not actually building anything, just a scam. And my pithy comment there is it's only 3.5% of what Theranos managed to raise.
Yeah, no, that they definitely should have shot higher. But my pithy comment will be, isn't this like 20% of all cybersecurity companies when it comes to putting out paperwork stuff that doesn't work?
It all comes down to intent. Did they intend to build a functional product
So if I write garbage that doesn't work, that's okay as long as I intended for it to work.
Yes.
Okay, I'll keep that in mind.
Yeah, as long as if you're neglecting engineering, not a scam at all. I don't. Did you have any thoughts on either of these, Katie? You can introduce the other one if you want to.
Reading the one about Netflix, former Netflix executive convicted of receiving bribes and kickbacks, it's not surprising. It should be surprising. Of course, I was also watching Succession earlier this week, so maybe that's where my mind is. But it's amazing that this goes on, but you have to wonder to what extent it's going on, because there is so much money floating around in the cybersecurity space that it's almost blinding. And I think we forget, having worked in security for so long, where we are in terms of in comparison to other industries, because there is so much money in this space, in terms of salaries, in terms of funding, in terms of acquisitions, all of that. And with that comes greed. It's unfortunately natural human behavior to some people. And it's really scary how this could have happened. And the one thing that we'll never know is what happened with these vendors. What happened on their end that they were allowing this to happen? Why didn't they perhaps have more confidence in their products? Were they just trying to get a really big name? Were they doing it, it goes back to intent, with good intention? Yeah. Or were they just trying to get a name on their leaderboard?
Yeah, there's so many different angles to this, right? Because I'm an advisor at a half a dozen companies, and I'm also the CMO of Jupiter One. So what happens if a company I advise and I make an introduction to Jupiter One to consider buying that product, right? The biases that occur when you have equity or an investor in a company are so difficult to manage that it becomes a slippery slope, and it's very, very easy for somebody like at a Netflix. Like if you land as a business, if you land Netflix, that's a huge brand that everybody wants to emulate. So you're able to say, hey, we have Netflix as our customer. So, that's going to drive additional business, significant additional business. And so I'm not surprised that, people fall into that rat hole of, hey, you know what, I'll buy your product, but you're going to kick me back this, you're going to take care of this, you're going to make me an advisor on your advisory board with some equity. And it's just such a slippery slope that you have to be very, very, very careful of to disclose those biases so you don't fall into this type of trap.
And the thing that bothered...
a lot of startups will, for certain buyers, it's almost expected that they'll be on, those buyers, big names, will be on the advisory board because they want to shape the product. They want to have some influence. They want to have some say in where the product may or may not be going. But that's done with good intent, and they're not expecting anything more than an opinion. So where the tipping point is, like you said, it's a fine line. But I mean, obviously, when you're getting kickbacks, that's not a fine line. That's a very clear problem. But I can see how, as a salesperson, I was in sales for many, many years before I switched over to what I consider the bright side. Sales is definitely the dark side. I can see where it would be so tempting, especially if you're that close on your quarter or the year or whatever, to be like, I can land Netflix. I can do this. It's just this one little thing.
Yeah, and I think there is this kind of fake it till you make it attitude, where too many of these companies are willing to overlook bad behavior and ethical issues like this to get to where they need to go. And once we make it there, like we're not going to let that go on anymore. But and I don't think it's explicit. I don't think the CEO is walking in and saying, "Do what you got to do, boys," or anything like that.
Sometimes it is though. Oh yeah, like there's definitely dirty people, but that's my point. Like It wouldn't surprise me if this, and I don't know the backstory, so I'm not claiming to know the backstory in any level of detail, but it wouldn't surprise me if this guy started with, hey, be on our advisory board. We'll give you equity to be on the advisory board prior to even buying the product. He then brings the product in. They buy the product. Now he's got the conflict of interest. And it just snowballs to the point where it's like, well, hell, if I'm going to bring in this new product, why don't you give me $1 million, right? I mean, some people don't have that moral and ethical dividing line. And it wouldn't surprise me if, some sales leaders are like, hey, you get the deal done. I fly you to, the Bahamas for a week, right? I mean, there's a lot of dirty tactics in this world. So I wouldn't be surprised.
For sure. And sometimes that line is super easy to cross. I know even in the events world, when I was back there, it would be, hey, let's get a bunch of CISOs and we'll have this great event at this wonderful resort and we'll fly them out there. It'll be a great honorarium. And that some people are going to go because they're going to get flown places for free. For the most part, that's harmless, but that's where it starts, right? And it's the more you get used to that and the more you get wined and dined and the more you get in a position of privilege, it's probably easier to cross that line. Sorry, I have a hungry cat here.
No, cats are welcome on all our podcasts.
When your 100%. Toe is being dipped in the water year after year after year after year. And I was at one company that wanted to do a customer advisory board, and the CEO was like, well, you just give them a little stipend. I was like, no, you don't do that. You don't pay people to be on your customer advisory board. That's a slippery slope right there. But these things, people are trying to think of ways to make it more attractive and maybe don't think through all of the repercussions.
And we don't even need to get into the analyst side of this, given our background, should we, Adrian?
Well, I mean, we'll have to come clean on some stuff. I know I've gone to a Kaspersky analyst event.
Kaspersky events, for sure.
Kaspersky, is notorious for holding events. It's not like there's nothing of value at the event. And the one side you can look at it is, hey, if we're going to drag people, out of their houses and into this event to listen to our speakers and see what new stuff that we've got to sell, we might as well do it somewhere nice, right? Like instead of just going to Vegas like everybody else, let's go to Punta Cana, which is where I went.
Yep.
So absolutely. Yeah.
The best thing I got as an analyst was AirPods. I mean, those are pretty good, but
I could regale us with stories. So I covered mobile security for a while, and I think I had six or seven different phones in 2 years.
Oh, wow.
Yep.
Yeah,
gotta know the phone.
It's definitely easier to review technology if you have it, but then whether or not you get to keep it, and that's just common in the phone world. It's not worth it to them to ask for the phone back, but definitely a lot we can talk about there. But sure. I want to move on to going to skip a couple here and just go to the last two here. Always want to cover our squirrel story of the day, but first, privacy. And this is almost like we almost have two squirrel stories of the day because this one's pretty bizarre. But it is privacy related, so, I can't really call it a squirrel story, but I don't know if either of you have figured out what's going on here. But a Silicon Valley entrepreneur, Sam Altman, wants a scan of your eyes. No explanation given for why he wants this that I could find. I don't know if you guys found anything in exchange for cryptocurrency.
I read the article a couple of times because I just wanted to be sure. They say that they're going to get rid of the original data. There's going to be no risk. Well, first of all, we know that's not even really possible. There's obviously a record somewhere and anything can be found and breached. But why anybody would do this? I don't know. I couldn't figure it out.
Tyler?
I'm looking at it. I can't say I understand it. What is the deal? They're scanning the eyes in exchange
For some Bitcoin.
Right. But what's the benefit? Like, what are they doing with the scan?
Well,
That's the question.
What are they doing with the scans?
Like, so you can see that he's the CEO of an artificial intelligence company group. Former president of Y Combinator.
Oh yeah, he's a baller. I looked him up. He's definitely got a history, and I think the idea might be to give each person a unique identifier, right? So scan their eye, get their unique biometric identifier, map it to some kind of unique hash of said identifier, and then map that to a wallet or to whatever financial instrument that we can say is uniquely tied to them and cannot possibly be tied to anybody else. So if you assume from a privacy perspective they are getting rid of the original scan of the eye and just using some kind of unique nonce hash, it seems kind of interesting. And add to that they've raised $25 million from Andreessen Horowitz, Reid Hoffman. It says in the article that Reid Hoffman gave the firm $1 billion valuation already. So I think there's something there, and the assumption here is that they're actually deleting the original unnounced data. But, that's where the question comes in. And I will say that cybersecurity people like you and I and the three of us on this call are immediately going to say, well, what about the privacy implications of this? Will the bulk of the people that are getting their eyes scanned even care? I don't think they will.
That's true. That's a good point. I read it, and I read what was written. I understand the idea behind it, I guess, but I can't imagine for the life of me why I would do that. But your average person will give up their password for chocolate. So
exactly.
Yeah. So I think an idea has formed as to why they might be doing this. That's not nefarious, and for Amazon, to put out their Echo product, their voice assistant product, and to have that voice recognition accurate to understand what people are saying, they need tons of data. They need people with Irish accents and Scottish accents and Boston accents and Southern accents, and they've got to churn that through this AI, through this machine learning, to get it good at figuring that out, regardless of how somebody talks. And it's typical with biometrics, whether it be fingerprints or eyeballs. They rarely save the actual source data. I mean, generally, if they're going to change the algorithm, sometimes they will save an image of your fingerprint or your eyeball or your iris or something like that. But typically, they turn it into a map. They turn it into a series of numbers. And I could see in this case where if they're trying to make better quality, iris scanning, some kind of biometrics that's really dependent on better quality eye scans, they need tons of data.
So I think it's a little bit bigger than that. So today, and maybe this is just my opinion, I don't know, but today it feels like each person's current identifier of who you are is your email address. You log in everything with your email address. What if that ceases to exist and you can log in with your unique identifier that they own, that they maintain for you, and it becomes like your digital certificate to map to your identity, and eventually turn that into the ownership of your financial world, your wallet, your access to different websites? Everything can come off of that central identity system. I'm guessing that's what they're building.
So instead of using this for authentication, using it for identification.
Yes, and yes, both. It could potentially.
Yeah, right. Of course. Interesting.
I think it's a really cool idea. But anyways,
I mean, we've seen Microsoft throwing away passwords, and email already seems pretty archaic as an identifier. And the combination of those two has led to credential theft as a really, really effective, one of the most effective attack methods out there.
I will. You can hear her from a prediction standpoint. In 10 years, we'll no longer use passwords and we will no longer use email as our identifiers. It'll be some kind of biometric like they're trying to build, coupled with some kind of automated multi-point identification of who's saying what they're saying, whether it's a fingerprint or a scan of your eye. In 10 to 15 years, that's what's going to happen. Passwords are dead.
Wow.
Yeah, I agree with that. And, passwordless is finally catching on after talking about it for, however many years. But at the same time, if that's the intent, gather all this data, do much better biometric scanning, I think that should be a little more clear in their messaging. Because to me, it feels like they're skirting the issue. If they came out and said all the things Adrian said, I'd be like, yep, get it, totally understand it. Still not comfortable with it from a privacy perspective and from a creepiness factor, but at least it would be a little more honest. And to your point, Tyler, there's definitely a need for passwordless. Passwords have been dead. They just wouldn't go underground for a long time. But the clarity in the messaging really needs to be better on this so that more people feel more comfortable. Because I'd be, as a skeptic, as a security person, a lot more comfortable if they said that, then, hey, just scan your retina, we'll get rid of your data, and we'll give you some Bitcoin in exchange.
It just sounds so shady without an explanation.
Right. It's not there's no explanation, and it makes me automatically go, what? Why?
Yeah, I mean, that's PR 101. Like, if you don't control the conversation and you let people just assume what's going on, it's always going to go negative.
I'll give it away for Bitcoin. Come scan my eyeballs. I'm fine.
They're going to send you a device.
Are you up for sale for?
Yeah, what's the cost?
What's your threshold?
Chocolate bar. I'll do it for a chocolate bar.
No, you said you wouldn't. You'd do it for candy, though.
All right, fine. I'll do it for a roll of Spree.
You didn't even like chocolate. Yeah.
I know. I'll do it for Spree. Give me nerds on a rope. I'll do it. You can have my eyeball.
All right. That brings us to our last story, our squirrel story of the day, which is, we've seen a series of companies, Beyond Meat IPO'd a couple years ago, Oatly IPO'd this year. A lot of move towards meatless and vegan alternatives to things. This kind of flips that whole thing on its head, and they're using yeast to generate real milk protein so they can make real dairy products that are vegan because they didn't come from any animal.
Oh gosh, I think I just threw up in my mouth a little bit at the thought of that. Like, it just doesn't sound good to me.
Sorry, man. That's the future. In your future, where we no longer use email addresses and passwords to identify us, chicken nuggets are grown in a vat, and so is cheese. And
we'll be eating yeast cheese. Non-dairy yeast cheese.
You can't tell the difference.
We already have fungus
They say
cheese.
You can't
What's
tell
the difference?
What's that?
We already have fungus cheese.
Right, like that's a key way that you make different flavors of cheese, right? Like you have to add mold and stuff to it.
Delicious mold, yes.
We use yeast to make every alcoholic drink. What's your problem? What's your problem, Tyler?
Well, if you gave me alcoholic cheese, I'd probably eat it though.
There is alcoholic cheese.
Now I threw up in my mouth a bit.
Wegmans has alcoholic cheese. It's delicious.
Let's make alcoholic fondue.
Alcoholic cheese. Oh my god.
Alcoholic fondue.
That's so gross.
There's whiskey
I have had beer cheese dip.
There's bourbon cheese.
No. You're missing the point. That burns off all the booze. I want cheese that's 100 proof.
You just dip it in your alcohol.
So it's like with the THC gummies all the kids are eating now. I want the alcohol version of that.
I think that's called alcohol.
Yeah, all right. I'll just stick with my.
It's called Jello shots. It's called Jello shots.
Fireball. Let's go.
All right, and with that, I think we're going to wrap for the news segment. And stay tuned. When we come back, I mentioned it before, we've got this great interview with Will Lin from Forgepoint Capital. Stick around and check it out.
Let's face it, cyber attackers have the advantage. ExtraHop is on a mission to help you take it back. Regain the upper hand with security that can't be undermined, outsmarted, or compromised. When you don't have to choose between protecting your business and moving it forward, that's security uncompromised. See how it works in the full product demo, free online at securityweekly.com/ExtraHop. SOC analysts are often overworked and underappreciated. In fact, 78% say that working in the SOC is very painful. Yikes. On October 20th, Devo is establishing SOC Analyst Appreciation Day to pay some long overdue kudos to you and encourage organizations to improve SOC analyst job satisfaction and mental well-being. Join Devo as they celebrate SOC analysts around the world and provide opportunities for personal and professional development, all while you unwind with programming specifically designed to help you de-stress. You can also win a Nintendo Switch if you participate in Devo's Twitter hashtag contest. All you have to do is follow at Devo_Inc. on Twitter and tweet using hashtag SOC Analyst Day. Visit securityweekly.com/Devo to sign up and learn more. Did you know that 81% of data breaches are caused by weak password security? Keeper Security's easy-to-use password manager platform keeps your passwords safe, easy to share, and out of reach of cyber criminals. Keeper is the leading cybersecurity platform for preventing password-related data breaches and cyber threats. Check out Keeper and get a free 3-year Keeper Password Manager solution when you take a demo of Keeper for Business. Learn more at securityweekly.com/Keeper Security.
Welcome back to Enterprise Security Weekly. Joining me for this interview is Mr. Paul Asadorian. Hello, Paul.
Hey, Adrian. How's it going? Good to be here.
Yeah, going good. Yeah, so we're pre-recording this, and it's always interesting doing one of these. Unfortunately, Paul will not be with us for the rest of the show, but I am glad you are here for this one. This is going to be a fun one.
Yeah, it's kind of weird doing shows remotely, but I apologize for my background. It's a little messy.
All right, few announcements. Don't miss any of your favorite Security Weekly content. Visit securityweekly.com/subscribe to subscribe to any of our podcast feeds and have all new episodes downloaded right to your phone. You can also join our mailing list, our Discord server, and follow us on social media and our streaming platforms. Security Weekly Unlocked will be held in person this December 5th through 7th at the Hilton Lake Buena Vista. Keynotes from Alyssa Miller, John Strand, Leslie Carhart, and Dave Kennedy. Visit securityweekly.com/unlocked to register and check out our rockstar lineup. And for our final interview today, we're talking to Will Lin, Managing Director and Co-founder at Forgepoint Capital, a VC firm that focuses exclusively on cybersecurity companies. Will is also co-founder and president of the Security Tinkerers, a nonprofit organization that brings together InfoSec professionals to share, mentor, and create opportunities in the community for older folks such as myself, veterans in the field, and newcomers as well. It's a place I spent a lot of time and really a labor of love. I think we all get a lot out of it, and it's really, really kind of precious to us. He's also a regular contributor to Security Week, is very knowledgeable, well-connected, and very generous with his time, like coming on the show to talk to us today. Welcome to the show, Will.
Thank you, Adrian. Really, really kind introduction. Appreciate it.
Yeah, so starting off, first off, how did you find your way to cybersecurity?
I fell into it. I think and this story gets more common now in security. You tinker as a young kid, love playing with toys and electronics, and then eventually you fall into computers and cybersecurity. I think for me, it really came from more the building and selling computers dynamic, having to deal with viruses early on, and then just sort of following that trend from then on.
Yeah. Falling into it is something we hear often when we ask people how they got into security.
No kidding.
Yeah. So, I mentioned Forgepoint focuses exclusively on the cybersecurity market. What were the reasons behind doing that? I guess more from an investor perspective, because there aren't a ton of VC firms that are exclusive to cybersecurity startups.
Yeah. I mean, And this is something I've started saying recently versus when we started. So I can't take credit for having this wisdom or these lessons learned when we started. Recently, I think the realization has been that in order to progress, in order to grow in today's industry or in today's environment, specialization is so important. You really, really have to specialize in something to progress upwards. And then eventually, if you're lucky, you get the luxury of being a generalist where you can do more than just one thing. And so following along that path, that's essentially what we did. We created a new venture capital firm from scratch. And we realized very quickly specialization would help us a lot in terms of helping us get to becoming one of the most active, one of the most well-known, and so that we can aspire to be like one of the storied venture capital firms that are 50, 60, 70 years old, that kind of thing. And so we are 6 years old now. We specialized in security back then. And, we're fortunate to be one of the most active investors, have the largest teams, have the largest portfolio in cybersecurity startups today because of that specialization. But the true reason is the founding team, 3 of us came from Trident Capital. We all had a deep passion for security. A lot of our successes came from cybersecurity as well. And so we decided to experiment and see what would happen if we decided to create a security-only fund. And it's led to a lot of success on our end, luckily.
I imagine, does it make it easier to raise the fund as well? Are most people kind of, generally, the same frame of mind that cybersecurity is pretty big, a good place to put their money?
This is one where it actually, in some ways, felt harder, right? Because when folks invest, including ourselves, we invest based off of our experience that's formulated into patterns. And based on those patterns, it allows us to make fast decisions and wise and thoughtful decisions going forward as well. And the issue is that there was no pattern for a cybersecurity focused fund when we fundraised initially back in 2015, 16. And so I would say it was actually harder. The other reality, though, is when you start a firm from scratch, it's always hard. And especially back then, we had just come from a huge recession. And a lot of venture capital firms were actually going under versus being created. And so it was also a very difficult environment. So it's hard for me to tell how much of it was because of the environment that we started in and how much of it was because of the focus in security. But we definitely got a lot of no's saying, hey, security is a niche. It's too small for a security focused fund. And so taking that feedback back, I would say that it did feel harder.
I bet those same people aren't saying that now, though.
They are not saying that now. They're not saying that now. That's right.
So speaking of these investments, for folks that know VC firms, not only just focusing on cybersecurity, you generally choose, what part of the path you're going to focus on, right? If you're going to be early stage, late stage, somewhere in between. Do you want to talk about that real quick?
Yeah. This is one thing that, and I'm actually writing a book on venture capital just because I've been in venture my whole career. My spouse is also in venture capital. And then a lot of my friends are in venture capital or in security or entrepreneurs. And so I feel like I've been able to learn from and experience a lot of journeys within venture. And when I initially started, and this is empathy for the audience, I didn't understand why there was seed stage, early stage, late stage, growth stage, IPO. Like there was just so much variety in terms of investing. And I didn't know why one person wanted to do only one type of investing. And this actually goes back to that specialization point from before. Whenever there is a bucket of similar opportunities, there is value in specializing and learning all there is to learn about that bucket of opportunities. And that's basically what's happening within the venture capital space. The companies that are raising seed capital, they need a different investor than the companies raising the early stage capital. And then the companies raising late stage, they all need something slightly different. The earlier they are, the more that they are asking, wanting involvement, active involvement from their investor. And the later stage they tend to be like all guns blazing, right? They have hundreds of people on their teams, and it's all about scale, scale, scale. And so they're at that point, they're usually looking for VCs to be less active, because the other dynamic then is they've already worked with 3, 4, 5 VCs that are on their board and adding value. Adding one more cook to the kitchen seems like a lot in the later stages as well. And so as a result, you need a slightly different value add. You need a slightly different way of thinking about things. And then lastly, we can talk about like sort of public companies, right? Those folks, they have much less involvement, / no involvement in the companies. And so you need to think differently when you're a hedge fund investor, for example, as well.
And from my perspective, having been an entrepreneur, I would think that a VC, an investor that specialized more, just focus on security, just focus at a single stage would be a better partner to have, because all their experience would be, specialized in that one area. You would have a really good idea of what a company needs at that point in their growth.
Completely. And in some ways, I have to defer to the wisdom of my co-founders or just luck, and however we want to categorize it. But we decided to specialize in early stage really early on, because for us, the security focus was a huge sort of specialization and sort of a strength, but we wanted to interpret as a strength. And where it's interpreted as a strength is in the early stages, right? When they really want someone to be hands-on to work with them side by side as well. If we were a specialist security fund only doing like hedge fund, it'd be good. It'd be a really knowledge-centric type value add versus a hands-on company building value add as well. And because we also really wanted to be hands-on company builders, it just made it very obvious and natural for us to be early stage investors. And so that was our strength, right? And in some ways, you want to find people who like you for your strengths, who appreciate what's the value add that you can provide. And so it's a win-win on both sides. And so we're happy to provide the value, and the folks want the value. And that tends to be in the early stages. The reality is that seed stage companies, they want the most value of anyone else, right? Because they're like 3 people, 10 people,
right?
And they have the least amount of resources that because they don't have the people or the funding to be able to have all the resources they need under the sun. But the issue is that seed stage investing is so different than early stage investing, where it's more the phrase is spray and pray, right? And we just really didn't want to invest in like 100 seed stage companies in security, and then for 80 of them to fail, for example. That would just really hurt our soul because of the whole company building dynamic that we wanted to do. And so in the end, it ended up being sort of perfect to focus in the early stages. So these are like 10 to 50 people type companies.
So, Will, when you are a company and you've moved beyond the seed stage, right. How do you advise your clients? I guess I look at 2 different areas, right? Growth in sales and marketing, and growth in R&D to diversify the product set. I guess I'm more interested in how you advise your investments on diversifying the product set while still maintaining their focus and point of view in the problem they solve in the market.
Yeah, I mean, it is. This is an unending question, I would say. Because, and this actually for me, when this type of question forces me to put on my product management hat. And so what I will say for this question is it's sort of like different depending on the situation, right? Like if you have a clear incumbent, everyone loves them, right? It's going to be really difficult to go head to head against that clear incumbent that it's universally loved. And so you have to think about how you market yourself, sell yourself, message, position yourself differently than in a market where there might not be a leader, or the leader is sort of on their way down in terms of credibility and confidence. And so you have to think a little bit differently that way as well. I would say the most difficult one, I think, is when you have to create a new market. A lot of initial excitement, because people are like, oh, they love learning about these new ideas, especially if it's a new idea that's compelling and interesting. But then it's such an emotional roller coaster, right? Like everyone loves learning a lot about it. They love talking to each other about it. And then in security, cynicism is high.
Yeah.
And so the cynicism adds on, and it's like, boom, no one wants to talk about it anymore. And so like you have to sort of balance that dynamic as well.
Yeah, it's interesting. It sounds like it's almost always a combination of sales and marketing and R&D, right? Especially in a new market. You really have to drive home, your go-to-market strategy if you're in or creating a new market. That's where I've seen a lot of companies struggle.
The holy grail is when all three of them work together perfectly. And when that does, and you're in the right market as well, that's when you have a public company, like just unicorn, whatever sort of metric you want to use in terms of success. That's when it happens. And so but the reality is that there are times when companies are really successful because of only one thing, really good sales, really good marketing, and then maybe subpar engineering. The only time where things don't work out is when you have phenomenal engineering, but really subpar sales and marketing, right? Because you have a great tech, but no one's buying it. So you're not generating revenue. You're not hiring people. You're not growing.
Mm.
Yeah, I think we've definitely seen some cases, the flip side of that. It's kind of amazing how far a company can go that aren't great on the engineering side. Don't have a great product, but just amazing sales and marketing can take you so far. And it's kind of interesting to see what happens there, because sometimes it's by design. It's like, we'll fix that, down the road, or we'll make improvements down the road. And if that doesn't happen,
technical debt is real.
Yeah. So and some of those companies, like once you get to a certain size, it seems like it's much more difficult to correct some of those shortcomings.
Completely. And it shows up in the technology, it shows up in engineering to the point of technical debt, architecture, all that. But it also shows up in the financials, right? Because the companies that didn't build a solution that scales will have lower gross margins, and they will be less profitable as well. And so everything shows up. It's sort of like an ecosystem. They all like work so well together, and you can find these signals in each of the factors to figure out, okay, this is how well engineering is doing, but just looking at the numbers, or this is how well sales is doing, but just looking at the code, for example. And it's these like small things that you pick up over time, and you sort of start being able to pattern match off of them.
Yeah. Do you look at customer churn a lot? Because that's one where I think that hits some security companies pretty hard, because oftentimes people don't fully understand what they're buying into when they buy it, and once they start using the product, they become more educated, because a lot of security categories are brand new categories.
Right. Yeah. Yes. Yeah. I mean, I think the interesting thing about churn is that when it's the new category, I do feel like people stay on longer than expected. Right, even if they are not getting the full value, sometimes when they could just end it after a year, instead they end it after 2 years or 3 years, because I think some of it has to do with the promise of the new category and the roadmap, saying, okay, well, I'm going to work on this, I'm going to solve this, I'm going to do that, and just like, okay, I'm going to wait one more year, okay, I'm going to wait one more year, and there's also the push, right? So, for instance, if the push was incredibly difficult to get the vendor in, it would be really painful and make that person look bad if after a year they canceled it, said, hey, I made this huge push to buy this thing and it sucks. Made a horrible decision and it sucks, right? And so there is that incentivization as well to keep going and say, okay, let's turn another page, see how it goes. Let's turn another page and see how it goes. Because of just all these human dynamics that, we're all we all have to empathize with and have gone through in our past as well.
Without getting too much into any proprietary investment strategies, can you explain to us a little bit about how you choose a company to invest in? How much of that is, we need somebody in this market that's really hot right now versus more just looking for the right founders, the right talent? I'm sure it's a mix of things, but
it's definitely a mix. I mean, I think the beautiful thing about, and this goes to the diversity point that we've all heard before, right? There's power and value in diversity. Everyone has a different lens. Like they have different filters. They have different reasons of why they're excited about one thing and they're not excited about the other. And it's like a combination of all their experience, it's a combination of all their mentorship as well. And so the high level point is it is different for everyone. But there are some core ingredients that I think everyone does use. Everyone does look at the team. Some people value it as the most important factor. Some people value it as third, fourth, fifth, whatever it might be. Everyone wants to spend time thinking about the size of the market, especially in venture when your big winners really drive your returns. You want to make sure that the bigger the market, the better. But the difference is that some folks will believe like, hey, this is a market that is tiny now or non-existent now, but could become a huge market. While some folks like, hey, I'm only going to invest in a market that's already huge, but they're going to displace the incumbent, for example. And so there's different techniques or dynamics in terms of how you think about the market. I think everyone spends time thinking about how the go-to-market motion, because that is and as we mentioned before, right? Let's say the two factors: sales, marketing, and then engineering. The one that really has more of a short-term and long-term, more measurable impact is the sales and marketing side. So some folks spend a lot of time thinking about, okay, what's the sales cycle? What's the average selling price? How much budget are you getting per year? They're looking at conversion rates. It's like, okay, every time you compete against this company, you win 80% of the time, 100% of the time. Who's your direct competitor? So spending time thinking about, hey, if I was a salesperson in your company, what should I expect? How hard is it going to sell? Is it going to be to sell this thing? How easily will it be for me to hit my quota? That kind of dynamics types of questions. And there's probably two more that I'm writing down in my book, but there's about, I would say that in the end, there's about 6 factors: team, product, market, go-to-market motion, timing. And then this one's a little bit fluffier, but I think it's so important, is product management or customer empathy. Their ability to pivot when the time needs them to pivot.
Yeah, I think that's huge. It's been my theory that it's harder for a security company to survive long term as a public company because of that need to pivot in the market. Because sometimes a category is good, it's needed, it brings value, but then the cloud happens, and you kind of have to pivot. As technology changes. Security kind of has to follow because it exists on top of other things, to secure other things. And when those things shift, and I think maybe it's a bit tougher as a public company, to easily pivot than maybe a private company. So I don't know if this is common in other markets, but we see a lot of take privates. They kind of reinvent themselves, mush them together with some other startups and, reinvent them, maybe take them public again.
Completely. Yeah. It's, for me, I love watching, I don't want to assume that every company that goes public or does really well eventually will fail, right? Because that's not true.
Right.
There are companies that they're able to persist for long term. And why are they able to do it? It's because they're the pivots, exactly to your point. Or the new markets that they grow into, right? Like I think one that everyone understands is the whole Netflix pivot to cloud, right? Or to streaming. I remember when they made that pivot, it didn't feel like it made sense. It wasn't obvious then.
Yeah.
but they made the pivot and they did it hard, and it's turned them to the amazing business that they are today. And there's so many examples like that.
So, fun fact, I don't know if you remember, but Hollywood Video and Blockbuster were not allowed to merge because of antitrust concerns, which seems ridiculous now, but at the time.
Right. Completely.
Yeah.
I guess my question along those lines, when I think about creating a new startup and folks creating new startups, is how do you differentiate a feature from a product, and how does that evolve over time? Because I see, larger public companies adding new features that are also like a whole category of startups. So how do you compete in from both, sides of that coin? Yeah.
I think this one really comes down to the customer, because taking a quick step back, from every entrepreneur's perspective, they want to be a platform, right? They want to have a full suite of solutions. They want to solve multiple problems. They want to be enduring. They want to be one day a public company, or almost all of them want this. Not every single one, but a decent chunk do, and it's a good enough pattern to assume most of the time. But why do they only market a feature versus a platform? Sometimes it is maybe they're just not aware that the problem that they think is a platform is actually a pretty small solution. That happens. I wouldn't say that's impossible, but I would say the biggest one has to do with what the customers are comfortable with, right? Because when you're a tiny little company and you're saying, I'm going to solve the world, the customers say, I don't believe you, and stop wasting my time, right? What can you actually reasonably solve for me today, or in a very, very short term? Because if not, I'm going to move on, because there are thousands of other companies to spend time to talk to as well. But there are some cases, and whether it's the team, whether it's the vision, whether it's the open space in the problem because no one else is touching anything, sometimes a company can pitch a huge platform solution and get away with it. Not in a bad way, in a, hey, people believe it, understand it, and are open to it as well. And so that's what I feel like is the bar, right? Like, if you can't convince a customer that you're a platform, don't try to. Don't waste your time. Focus on what you can solve for them in the short term. And then over time, they will want you to become a platform, right? You're already in there. They want you to grow. They want you to solve more problems. They want you to do more for them. So there is a very natural win-win down the line. The big thing first is just, let's start working together. Let's get something going.
Listen to your customers, right? Once you've got your foot in the door.
Completely. I don't think any customer says, hey, I only want you to do this until the end of time. Please don't bother me forever, right? Unless it's a really boring problem. And it's such a commodity problem and a commodity solution. Sure, fine. But generally, people like the idea of working, of getting more value from their existing solutions. And then if they have to pay more, they'll, and the ROI is clear and obvious, fine. It's a win-win. I'm comfortable with it. But and so there is a very natural way of partnering well with your customers, and you just have to just keep crushing it. Just keep doing well.
It's a long road too.
Completely.
Yeah. So I was just going to jump ahead and pivot a bit, since you mentioned companies getting away with really big platforms. On some of the key transactions I wanted to talk about today, and we're not going to get to all of them, but there are a couple that kind of fit that mold, I feel like. And so there's SNCC, raised a Series F, $605 million at an $8.5 billion valuation. I forget how old SNCC is at this point, but I think they're actually the oldest of the three I'm putting in this category. We also have Orca, who is I think they're barely 2 years old, and they raised a 550 million Series C extension on top of a 210 million Series C, valued at 1.8 billion. And then Wiz, who seems like they're directly competing with Orca in a lot of places, $250 million Series C. They're 18 months old, or at least they were when they announced that in October. Earlier this month in October, and $6 billion valuation, 18 months old.
Yeah. How far back or how high level, how economics do you want me to talk about? I can talk about sort of why VCs doing what they're doing, why the entrepreneurs are doing what they're doing, what are the different factors that are causing it. Like in the, actually, why don't I just start and then you direct me?
Sure.
Yeah. I think if I were to try to hone down everything, like these 3 deals, what are people doing? Why are they doing all that stuff? It really all comes down to the amount of capital that needs to be invested in today's world. Low interest rates, people need to beat inflation, and best and even better, they need to grow those savings that they do have. And so in today's world, the traditional places to invest have gotten less and less valuable. And so as a result, more and more money is being put into venture capital. And and that venture capital dollars is being used to invest in companies. The trick or the style or the way that people have been primarily evolving in today's world because of all the dollars is with the preemptive round, which is basically saying, hey, everything you're doing, it looks like in 3 years, 2 years, 1 year, you are going to hit exactly what I normally invest in. And so I'm going to invest in you now, 1, 2, 3 years early, because I have confidence that you're going to hit those metrics that I normally invest in. And so I've gone earlier stage. And that's essentially what almost everyone has done, right? So an $8.5 billion valuation, for instance, for Wiz, that's a public company valuation. It's basically saying, hey, I know for a fact that Wiz, Orca, Sneak are going to be public companies or essentially there. And in a certain amount of time, and you have more than enough money to spend to grow, and so that eventually in however much years times you will be the company that I normally invest in, and eventually you'll become a public company. So there's that dynamic to just sort of see how it's all flowed to where we are today. The other dynamic, which also comes from the low interest rates, is the public market multiples have increased as well. And so in order to be a public company, you actually need less revenue now because the multiples are so high. Before, you had to almost always hit $100 million of revenue in order to be a public company, and you'd be valued at 6, 7, 8, 9, whatever, like some range multiple there. If you're like an exceptional business, and there's 1 out of 20 or something like that, they get like a 12, 13, 14, maybe 20x multiple on revenue. But now 20, 30, 40, 50 is more common. And so you can be a smaller company and be valued the same way that people have been in the past. So that's a second sort of underlying driver that's occurring. And then the third one is not related to interest rates, but related to technology evolving, related to globalization, related to more people doing business on the internet. It is possible to grow your business revenue-wise a lot faster now than it was in the past as well. And so because of that maturity, because of that digital way of doing business, you can also get to that, let's say the $100 million revenue number is the goal. You can also achieve the $100 million revenue faster in today's environment than it was in the past. For me, the way I've noticed sort of the world is, people like leaders. They really love leaders, right? Because, you associate a lot of great things to a leader. You associate that they will be the leader for a long time as well. And so their roadmap is going to be better than their peers. You associate that they are going to hire and get the best people because they're the leader in their space. You associate that they're going to grow the fastest. I mean, it's an amazing position to be a leader. And so as a result of that, that's why the leaders are growing so fast, because the customers are thinking the same way as well, where they're like, okay, I have a problem. I have budget. I think the best place for me to put it is with the leader of that space, of this problem, that's solving this problem. And so, and that's how the VCs are thinking about it as well. Should we break that bias, that leadership bias? I don't know. I'm still trying to form an opinion on it, but there is that bias in humanity where we really, really, really love leaders.
And I guess the thing giving me whiplash is that, less than 10 years ago, security companies would IPO, and get maybe 100 million out of it, 200 million out of it, and the growth, like a lot of growth would be anything over 20% year over year. Now we've got SentinelOne, I think, raised over 1.2 billion with their IPO, and the stock, like CrowdStrike, has just gone up from there. And now we're seeing some of these faster growing companies raising every 7 months instead of every 18 months, which used to be normal. And I got to think like the sales cycle has to be fairly short. And like you need to go off of new metrics, like year over year growth rate. Like, forget that. We're talking month over month growth rate, aren't we? Or something like that.
Yeah, I love this question because it's sort of a question that's like, when you're not. So the preemptive thing is just amazing. It's just so amazing to watch. I just like the what's going on in these companies is that they are raising more and more money despite not spending the previous money that they've had. Right. So historically, the way to do things was you raise, let's say, $20 million and you spend that $20 million in 18 months to 2 years to the point that you made. And so you could actually have a decent guess of how much money they were burning because of when they were raising. And then you would hope that if they're burning that much money, they're also growing. And then what you can do is you can do an efficiency, right? Like, okay, they burned $20 million, but they added 40. Holy crap, super efficient. That's like, we need to invest more money into this business because it's like a money machine, right? You put in $1 and you get $2, right? It's like, why not put more money in that machine?
Right.
So that's what it used to be, and that's still happening. But these like landmark cases, right, or these like newsworthy things, are situations where almost everything's preemptive. It's a different way of measuring it now. It's like, how many times can they get a preemptive round before they really need to demonstrate growth and demonstrate the numbers, right? So going to that, the way I described preemptive just now, you invest in the company and you're like, hey, I believe that in 1, 2, 3 years, you're going to be the company that I normally invest in. And so even though you have, let's say, 30 million of cash on the balance sheet now, and you're going to spend that $30 million over the next 2 to 3 years, I'm just going to give you credit for those 2 to 3 years of growth. Assume that you spend out all that $30 million, and I'm going to give you another 50, 100, something like that. And so now you're capitalized not only for the next 3 years, you're capitalized for the next 6, 7, 8, 9 years, that kind of thing. And so in the meantime, I'm just going to hang out. I'm going to add value for 9 years instead of adding value for, let's say, 6 years, something like that, making numbers or making time. And so that's what's going on, right? Like they aren't spending this money like crazy. So for instance, like the Orca number, right? They raised 200 something, and then the 500 something. They didn't spend all that 200. Like there's no way, they spent anywhere close to all that money before they raised this $500 million round. It's basically they're just capitalizing the business. Now the company has so much money. It's pretty much the next round is IPO. And And this actually brings me to talk about another factor that's driving all this stuff, but we don't have to go back to that one. But there is that's sort of what's going on. It's this feeling of I already have a lot of money. If you want to give me more, you have to give it to me at assuming that I've generated a whole bunch of success.
Yeah. Well, man, we're going to have to do this again, Will, because I've got so many other questions. This has all been amazing stuff. I've already learned a ton in just 30, 40 minutes here. But yeah, thank you so much for joining us on Enterprise Security Weekly today.
Thanks, Will.
I was delighted. Thank you.
And thank you, Paul, for joining me today. And a big thanks to everyone for watching or listening to this week's episode of Enterprise Security Weekly. We'll see you next week.